called a resistance level. It is a reference point in the market because this is the area where price was rejected by sellers and where some traders decided to take profit. Now look at what happens next. The market makes another move upwards, breaks the resistance level, and then pulls back. Once this level is broken, it turns into support, and it still acts as a reference point. When the market returns to this level, we can anticipate the beginning of a new impulsive move, and this is where Muni Hisahoma comes in. We use candlestick patterns to confirm the end of the retracement and the beginning of a new impulsive move upwards. Here, we have a clear Tsutsumi pattern that appears and indicates the end of the retracement and the start of a new impulsive move upwards. So remember, during a markup phase, you identify the previous resistance level that was broken. You wait for a retracement back to that level. The resistance becomes support, and once the market reaches it, you wait for a candlestick pattern to appear. Now look at another chart example. During the markdown phase, the market exits the distribution phase and starts trending down. In this scenario, you first identify the end of the impulsive move and the beginning of a retracement, then you draw the support level. Next, you wait for the market to make another impulsive move and break below this support level. Once the level is broken, it becomes resistance. Then, when the market retraces back to this resistance level, you wait for a candlestick pattern to appear. This could be a pin bar, a tailed bar, or any other formation. The exact name doesn't matter. What matters is the signal. It must be a clear, bearish signal. This is your confirmation that the retracement has ended and that a new impulsive move to the downside is likely to begin. That is the move you want to trade. Look at what happened. As you can see, the market moved down. Now, an important note. When trading accumulation and distribution phases, you don't need multi-time frame analysis because you are trading against the trend. However, when trading a trending market, whether up or down, you must use top-down analysis because you are following the new trend. Now, let's look at another chart example using multi-time frame analysis. Look at this chart. As you can see, the market was initially in a distribution phase, meaning it was ranging. Then the market exits the range and begins a downtrend. Now, here's the key moment. Price breaks below a key support level, confirming bearish momentum. After the breakout, the market retraces back to retest the broken level, which now acts as resistance. At this level, a Nagaraboshi candlestick pattern forms. This pattern shows rejection from higher prices, sellers taking control, and the likely end of the retracement. This is your signal that a new impulsive move downward may begin. Since we are trading on the 5-minute time frame, we need confirmation from the higher time frame. So let's switch to the 1-hour chart. On the 1-hour chart, the market was trending up. It reached this level and reversed, forming a resistance level. Then, price came back, broke above it, and closed below it, creating a clear liquidity sweep. This indicates that the market is likely to reverse and move down, and that's exactly what happened. The market continued moving lower. This also suggests that price is likely to keep pushing down, meaning the higher time frame is aligned with our trading time frame, which supports our trade setup. Now let's go back to the 5-minute chart and evaluate the trade. We enter at the close of the Nagaraboshi candle. Our stop loss is placed above the rejection wick, and our target is set at the next key support level. This gives us a minimum 2-to-1 risk-to-reward ratio, which makes the trade valid. Now let's execute the trade and see what happens. As expected, the market continues downward and hits our target. Look at this chart. As you can see, the market exits the accumulation phase and begins forming a markup phase, which means buyers are now in control of the market. The market started forming higher highs and higher lows, and at this point, it broke above a key resistance level, which then became support. The market then retraced back to this level, forming a clear Tonkachi or a doji candlestick. The exact name of the pattern doesn't matter. What matters is the rejection. This rejection indicates the end of the retracement and the beginning of a new impulsive move to the upside. Since we are trading on the 5-minute time frame, we switch to the 1-hour chart. As you can see, the market was previously in a downtrend, and then it shifted into a strong uptrend, clearly indicating a trend reversal. This higher time frame confirmation supports our trade setup on the 5-minute time frame. Now let's go back to the 5-minute chart. We enter the trade at the close of the Tonkachi candle. Our stop loss is placed below the wick, where buyers showed rejection, and our target is set at the next key resistance level. When we measure the trade, we can see that it offers at least a 2-to-1 risk-to-reward ratio, making it a valid setup. Now let's execute the trade. As expected, the market continues upward and reaches our target. One of the most common mistakes I see is traders trying to force the market into a perfect cycle. They think the market must always follow this sequence: downtrend, accumulation, markup, distribution, and markdown. But in reality, the market doesn't work like this. On real charts, things are not that clean. If you think this way, you will get confused and make wrong decisions. Let's look at this example. As you can see here, the market formed an accumulation phase. Then, we see a clear spring, after which the market exits the range and starts trending up, entering a markup phase. After that, the market enters another range. At this point, you might think, all right, I need to prepare for a sell because the market is entering a distribution phase. But this is not correct. Look at what happens next. The market breaks out of the range again. This is not a distribution phase, but another accumulation. In this case, you have two choices. Either wait for the market to retrace back to the accumulation zone and look for buying opportunities, or wait for a clearly established markup phase and then join the uptrend. Now look at what happened next. The market retraced back to retest the second accumulation phase, and this is your opportunity to join the new markup move. As you can see, the market moved up as expected, so don't make the mistake of following any method blindly. The market is dynamic, it doesn't follow fixed rules. As a trader, you must learn to adapt. The second mistake most traders make is ignoring the volume indicator. Look at this chart example. As you can see, the market was trending down, and then it entered a range. The first mistake traders make here is assuming that because the market has already moved down for a long time, it must reverse. So, when the market enters this range, they think it is an accumulation phase, and they interpret this rejection as a spring. But look at the volume below the chart. You can clearly see a large red volume bar, which indicates strong selling pressure. This tells us that buyers have not entered the market yet, and this is not a valid signal. If you take this setup without analyzing the volume, you miss a critical piece of information. Buyers are not interested. Now look at what happened next. As you can see, the market continued moving down and did not respect the supposed accumulation phase. If you don't use the volume indicator, you might think the method doesn't work. But in reality, what you missed is a key confluence factor, the volume. And with that being said, always remember that the market will not follow a perfect structure, so don't try to force it. Instead, focus on confirmation, use volume, and follow what the market is showing you, not what you think it should do. If you found value in this lesson and want to support the channel, feel free to like the video, subscribe, and turn on notifications so you don't miss the next trading lesson. Thank you for watching and see you in the next video.